Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge and up to number 99, part 8 in our series here on investment property. This one's all about the different types of loans we could get for our investment property. There's our disclaimer, facts and figures, information only. This is not advice in today's video. Our first sort of choice we're going to look at with our loans is, are we going to get a fixed loan or a variable loan? Now, a fixed loan basically means that the interest rate on your loan is fixed for a period. Now, it might be 12 months, 2 years, 5 years, and having your interest rate locked in at that particular rate. Now, so you're basically doing that for a couple of reasons, maybe for certainty, so that you just don't want any major surprises with interest rates going the wrong way against you. So you know what you're going to repay. And probably in the first few years of an investment property, when things are a little bit sort of unknown, having a fixed rate can indeed be quite useful to at least you know exactly what your mortgage payment is going to be. It could be the fact that you believe interest rates are going to go the other way, interest rates are going to go up, and so you believe then that by locking it in, you're going to protect yourself from further rises there. But of course, banks aren't stupid. Banks aren't stupid. Well, we hope they're not. But they basically have got a pretty big teams of specialists and people looking at the market and so forth. They've got a pretty good idea which way they believe interest rates are going to go. So when they set interest rates for their users, their customers, then normally the bank is not going to miss out. So they're setting it at a rate where they believe over the period of that loan, they won't be caught out themselves and finding that they, by locking them in, you're getting a very good rate when interest rates have actually gone up. Now, of course, that wasn't quite the case over the last couple of years, where interest rates sort of went through the roof quite quickly, and quite a few people I know locked it in under 2% for 4 years. How delightful was that when interest rates indeed went up? A variable rate, of course, is as soon as the Reserve Bank changes the official interest rate, the banks then seem to follow very, very quickly afterwards. Hence, you could find that your interest rate on your loan is changing up and or down depending on which rate the rates are going. They tend to go up much quicker than they do to tending to come back down again. But it's interesting, I read a few articles on this, and because this whole business of the banks doing their research, then there's only been a few rolling periods over the last 2 or 3 decades where you probably would have been better off on a fixed rate, and the rest of the time a variable rate you would have been better off, literally because I say the banks are setting the rates to make sure that they're no worse off by doing so. So it's a little bit of a gamble. We don't know in advance. People can sort of think they know which way interest rates are going to go, and you've only got to look at the difference in the different assumptions from various different organisations telling us what interest rates are going to be and how many rate rises are going to be and so forth. Could be a case you might want to hedge your bets by having a split loan so that you can have half of it locked in to give you the certainty, half of it on the variable just to sort of in case interest rates do start to go back down again. So you're getting perhaps the best of both worlds there. Be aware that with a fixed loan, there may be some restrictions on how much you're actually allowed to pay back during that period. Normally with a variable loan, there aren't any restrictions. You can sort of virtually take a variable loan out and pay it off as fast as you like. Fixed term loans, you may find that you're limited to $10,000 extra repayments. Some may not be able to do anything. Just depends on the bank, depends on the loan, depends on the fine print of your loan. The other types of loan is the difference between, we sort of hinted about this a little bit in various sessions here, about do we go interest only or do we go principal and interest? So an interest-only loan is where we've taken on a loan of $500,000 and really, certainly in the earlier stages, we've got no intentions of paying that $500,000 down. We're going to pay the interest because the bank will want that. So we've got to pay the interest on our loan. So if our loan was $500,000, we had a 5% interest rate, $25,000. We'd have to pay $25,000 to pay that interest off in the year, plus of course any fees applicable. And a principal and interest is not only are we going to pay the $25,000 of our interest payment, we're also going to be paying something off the $500,000. And so if you've got a 30-year P&I loan, then over the 30 years, after the 30 years, there is no loan left. With an interest-only loan, you might have it interest-only for, say, 5 years, and at the end of the 5 years, you could then switch it over to P&I. Could be you could then just roll it into another 5-year interest-only loan. Might be 3 years, might be 5 years, depending on what the bank will offer you there as far as an interest-only period. A lot of banks eventually will say, look, come on, you've been on interest only for so long, how about you switch this over? And if they do, you could always just go to another bank, I suppose, and restructure it as an interest only. I see a lot of accountants are quite happy for you to just have an interest only loan against a rental property, because it's only the interest that's the tax deduction. So by paying the interest, you're maximising your tax deduction. And of course, it means that the money that you would have been using for your P&I, by paying down the loan, we can use that money for other investments or even perhaps for another property. But it comes down to the situation that the idea here is that even though we're not paying the loan down, our capital value is going up, literally because the property is going up. So we buy a $500,000 house, we have a $500,000 debt using the equity of our own home for this investment property. The property goes to $1 million. We still only owe $500,000, and so we've now made $500,000, but we've had to pay this interest all the way along. Look, it does come down to your own situation as to your cash flow. In the earlier years where it may be negatively geared and you don't have a lot of spare cash, then by having this interest only, you're keeping your cash flow in an improved state. But as perhaps the value goes up and the rents go up, then effectively the extra money we're getting from the rent, we can now apply to a P&I loan and then start to pay it down. I must admit, when interest rates were hovering down at 2% or so, to me, I couldn't really see why you would just do interest only at that rate, why you wouldn't indeed take some extra money and indeed reduce the principal of the loan while we had an opportunity at such ridiculously low rates there. But of course, by reducing the principal of the debt, by getting our $500,000 down to, say, a $400,000 debt, it's improving our security because we now own more. If the house prices do drop, we're not going to find ourselves in a situation where we're in negative equity, where our property is worth less than the debt that we've got on it. I do like using mortgage brokers. They came in for a lot of flack during the Royal Commission because of their structure. Basically, you don't normally pay to go and see a mortgage broker. They get their benefit, they get paid by procuring a loan for you through a bank, and then the bank that they get the loan through gives them a bit of a kickback. Now, of course, that sort of sounds like a bit of a conflict of interest there, in the regard that are they really going to find you the best loan, or are they going to find you a loan where the bank is paying the best amount of money as an interest to them? These days, most mortgage brokers have to indeed provide you with a list of the ones they were looking at, showing you what they would have got as commissions and so forth. And if they do indeed happen to choose one with one of the highest commissions, they've got to basically come back and tell you why and explain it to you. And if the reasons aren't good enough, well then okay, move on. But why I like a mortgage broker is the fact that they doing this on a regular basis. They know the banks and how they will look at your scenario. You may have some oddball things. You might have a small business, and they know damn well that some banks won't even look at you, or they certainly won't be very interested in you. You might have intermittent work history, or it could be a whole range of different things there. But they get to know the banks that say, okay, we don't mind that, so long as blah 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 blah. So a mortgage broker can sort of short circuit you bouncing around banks and so forth. They will certainly have their finger on the pulse as far as interest rates are concerned to know what to do there. And of course, what I really like about them normally is that they've got the structure. A good mortgage broker, even perhaps with a bit of a financial planning background, would be good in the regard that a good mortgage broker would look at what you're trying to achieve and over what sort of time frame, what is your scenario, your income, and your overall debt levels and so forth, cash flow. And therefore they set up the loan structure to suit what you're trying to do, and then they go looking for the bank with the best interest rates and so forth and best fees and things to accommodate that particular structure. Just chasing interest rates is not what it's all about. You might indeed benefit from having a split between fixed and variable, P&I and interest only. You may find that having 3 offset accounts may be useful for whatever reason may be. Now, not all banks are going to give you that sort of structure. Good mortgage broker would know how to do it, how to negotiate it, and sort of go forward from there. But it just gives you that sort of ability to really sit down and discuss your loans and what you really should and how they should indeed be structured. They will handle all the paperwork for you as well, and mortgage paperwork can indeed be a little bit daunting. There'll be lots of information they're going to be asking you for. There'll be a lot of backwards and forwards. If you can get a good relationship with a good mortgage broker on top of it, he can sort of circumvent a lot of that, saying, okay, this is what we need up front before we even start, and to make it a far more sort of streamlined sort of process. So, yeah, pretty good. I like mortgage brokers. Getting a good one is certainly ask around and talk to your friends someone who's used one. In fact, you can always talk to us. We've got some mortgage brokers that we've used over time. Happy to have a chat about it, and look forward to joining you on a next session.